In this video tutorial, we're going to be talking about buying call options. Buying call options can be a very lucrative strategy where you can multiply your money very quickly, especially if a stock goes up due to earnings. Now, the example I want to go over today is going to be on Meta. Now, obviously Meta went up a lot as I'm making this video, but this is just a tutorial video. So if you're watching this in the future, just copy the same logic and blueprint to do this again and again in the future. So look, Meta went up a whole lot, and that's because their earnings were really good, better than expected. And as you can even see, Robinhood right here is saying that they're experiencing elevated volatility. Now, typically a lot of people get worried when there's volatility, but as an option buyer, specifically if you're looking to buy call options, that is a really good thing. In fact, when I used to work at Wall Street, when I asked the trader, aren't you afraid of volatility? He was like, heck no, I love volatility. I love when stocks move up and down because when you buy options, they increase in value. Even if the stock goes down, but the volatility shoots up, it can increase in value. So let me show you an example. Here, Meta went up about 20% in one single day. So if I go to trade Meta options, I'm going to show you what buying a call option could have done for your money. So in the short term, as you can see here, it went up 3,000%, 2,700%, 2,500, 2,200, all across the board, 1,000 to 2,000 or 3,000%, the call option went up. So you can basically 10 to 20x your money. Now, again, it's really difficult to predict a stock going up so much like this. Nobody really could imagine that Meta would blow past, all expectations. But this does happen quite often during earnings. I mean, not just Meta, but a lot of different companies. If they report better than expected numbers, then the stock shoots up, and then instead of making 20% on the stock, you can make 2,000% on the option. Going over an example, we could have bought a, say, out of the money option here at 450. This option went up by 2,200%. Now, it was out of the money because Meta obviously shot up a lot. So if we look at Meta right before it reported earnings, you will see here, if I go to the 1 week chart, right before earnings, it was sitting at just almost $400. And then it shot up to $478. So had you bought in, say, a 450 call option, which would be out of the money, right? A lot of people would not expect Meta to go up so much. So this would have probably been a very risky play. However, check it out. This went up by $25.70, and now it's worth $27.30. So this option was trading for $1.60. That means you could have put $160 in play, and you would have gotten right now $2,730 after they reported earnings. So it can be really lucrative to open call options. So it can, and oftentimes during earnings is very profitable to buy call options. Now, buying call options is a very bullish strategy. So in addition to the stock going up, a call option functions in the way that it goes up more than the stock. So when you buy call options, which is one of the most basic strategies, you are benefiting when a stock rises. So here in the 450 strike example, if the stock went up by as it did by $50, this option actually went up so much more in terms of value. Now, I can also show you how the strategy worked on Amazon. So Amazon also had a really big day. Obviously not as much as Meta, but that's okay. Let me show you how much a typical call option can make during an earnings event. So Amazon was trading for around $155. Now it's at $170. That is a very big move. And if we look at the call options here, you will see that they also have gone up quite a lot, but only 76 to 100%. And that is what's more typical when you're buying call options for earnings. You can make between 50 to 100%. So you do need to hit quite often on a long call option to make it profitable, which is why I would recommend that you manage your risk properly by only putting about 5 to 10% of your money in buying call options. One of the biggest mistakes I ever see, and many of my students come from, a buying option background. So when you're buying options, you can get really big returns, but you can also end up losing a lot of your hard-earned money. When buying call options, it's really important to manage your position. So if the stock is going up, then great, you can keep holding your call option. So for example, let's say that Amazon already had earnings, but there's 6 more days and you think that the stock can run up. So let's just go over an example right here. The maximum profit is unlimited. So in this example, Amazon could keep going up and you could end up making a lot of money. But most likely the stock may go up a little bit and you are risking $225 here. So you do risk whatever you pay for the option. The premium that you pay, that is an upfront value that you pay, and you can lose the entire amount. Now, you can't lose more than what you pay. So here we see that $2.25, that is the payment that you put up front, and then your expectation is that the stock will rise in value. So Let's say that the stock goes up to 172.5 and it ends there on Friday of expiration, February 9th, as I'm making this video. Well, in that example, you actually still lose $225 because your break even is 174.75. You get that by actually taking the strike price plus the premium to get your break even price. So when buying call options, a trader told me that you need the stock to actually go up quickly in a certain period of time and a certain amount. So it needs to go up a lot and fast. That is a risky predicament. However, buying call options can be fantastic for multiplying your money as long as you use it appropriately with the rest of your portfolio in proportion, which is 5, 10, maybe even 15%. If you're buying call options, the best way I found to make buying call options actually work is to go for shorter term call options. Now, if you do go for a very long-term call option, like let's say it's 6 months or more, then it begins to be a leap option, a leap call option. A leap call option is just a longer term call option, and those can be really good if you're betting on a stock going up after multiple periods. However, short term, if you're trying to make the most money, buying shorter term call options probably has the biggest, if not literally out of all the strategies, the biggest reward. However, it also comes with the biggest risk. If you want to know a better way of buying call options, which is the poor man's covered call, I have a video on the screen that you should watch right now.